Long-term investing is the most powerful way to grow your wealth over multiple decades. There are countless videos out there that dive deep into the weeds of the more advanced aspects of investing, but the basic concepts are not often explained. I'm talking about simple things like when to invest and what to buy. I get asked these two questions all the time. I hope this video provides a quality answer for most of these inquiries. We'll walk through what I think is the best way to invest $10,000 in each decade of our investing careers. We'll also cover the pros and cons of lump sum investing versus dollar cost averaging when you receive a windfall of money from something like a bonus or an inheritance or anything else. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please tap that like button and subscribe to the channel if you enjoy videos like this. And feel free to drop me a comment with anything that comes to mind as you watch it. We have 10 new channel members this week. I'd like to give a huge thank you to all 10 names that are on the screen now. These are the new members. And a thank you for all of you that have been here all along. I thank you for this extra level of support. You are truly making this possible for me. The only announcement I have with the spreadsheets is that I've upped my game with the retirement planner. I now have combined part 1 and part 2 of building that retirement portfolio and then ultimately the year-by-year guide of extracting the money out of it in retirement. The spreadsheet now handles both of the scenarios from the respective videos. For anyone interested in joining the channel membership, the link is in the description below, and you get access to all the spreadsheets you see in my videos and a few other ones, emotes, badges, and really it's just a way to provide extra support to the channel. But these videos that you see each week will never be locked behind a paywall. Let's grow. Setting the stage. There is no one size fits all in investing, but there is one size beats almost all. The perfect portfolio for you will depend on factors such as your age, your risk tolerance, your current income, your current wealth, and your retirement goals. The age-based investments that we cover in this video will likely apply to you as long as you're on a somewhat normal career trajectory. Now, if you're the type that wants to retire when you're 30 because you sold your startup company for millions of dollars, then you probably will do it differently than other 30-year-olds. This information will provide the information you need if you plan on retiring in your late 50s to early 70s. We're going to tackle the when and how to invest before we get into the specific holdings. Lump sum investing versus dollar cost averaging. This is probably the most common question I get, and it's one of the great debates in the world of investing. And I should probably start with this. There is no universally agreed upon correct answer to this question. Let's say you inherited $100,000 that you were interested in getting invested. Lump sum investing, or putting it all in the market right away day one, just throwing it in there, is the better choice around 67 to 80% of the time, depending on what study you use. And this makes sense if you think about it. The market goes up by 10% per year on average over the last 100 years. So in general, you want to get that money in there and growing, working for you as soon as possible. However, lump sum investing comes with much greater risk. You could drop that juicy 100,000 into the market only to see it be worth 50,000, even though it's in the perfect portfolio mix because you did it right before the next big crash. Will the market crash? Yes, there is a 100% chance. When will the market crash? Nobody, and I mean not a single person, knows. Dollar cost averaging in the scenario above would have saved you a lot of money. You didn't have it all in there just to have it crash. And it's actually even better than that because after the market crashes, you're still a buyer. So you're getting more shares for every dollar you trickle in there as you dollar cost average in. But the thing is, the market doesn't really crash that often, and we just don't have a crystal ball to know when it's going to happen. So I want to tell you what I think is best in theory, but at the same time, I'm going to cut out all the BS and tell you what I have personally done in practice. I've received 3 large lump sums of cash that I wanted to get invested. All 3 of these being my old 401k that I'm transferring over to my rollover IRA. And in every case, I've dumped every dollar in day one. And it's kind of funny because I am the statistic. 2 of the 3 times, 67%, worked out really well for me. The other time wasn't the greatest timing in the world. I think that if you are dollar cost averaging money into the market in general from your normal job, then lump sum investing a windfall makes a lot of sense. Now, if you're retired or your life situation doesn't allow you to be dollar cost averaging into your portfolio at this time, I would probably use a hybrid approach. For example, in this scenario, I might take $50,000 or half of it and lump sum it into my portfolio mix. And then I take the remaining $50,000 divided by the amount of weeks I want it to take to get the rest of the money in there. I usually use about a year. So in this case, I would probably do $1,000 per week over the next 50 weeks to get the rest fully invested. It just gives you a nice balance between getting in early, because generally speaking, that's better, but then you still have some in reserves that you're trickling in. So far, we've just been speaking about a windfall of cash that you receive. If you have your regular income, you need to make it a bill. Put a high priority on dollar cost averaging into the market over multiple decades. Your future self will thank you. Let's get into our age-based investments. Investing in your teens. Congratulations. The fact that you're investing already, or that someone else is investing for you, all but guarantees that you're on your path to building serious wealth. You don't need to worry about things like your dividend yield at this point. And most people have this one backwards, but you don't want to take chances on hand-picked stocks either. The flawed logic is that you think you have a lot of time to make mistakes, get out of your system, pick some losers, because you ultimately have years and years ahead of you to move into the passively managed ETFs later on. But does this make sense? No! The magic of compound will do its thing the earlier you begin. These small mistakes in your teens will compound into 6 or 7 figure opportunity costs long term. Let's jump over to my screen and see how teenager Teeps would go about this. I threw together this quick spreadsheet and I have a tab for each age range. We're on the teen tab right now, but just a high level view here, we have holdings right here, and this is just the different tickers. This is the percentage that I would put. So you have $10,000 to invest for each one, and this is the percent I'd put into each ticker. And then the yield is the dividend yield. This is the dividend dollars received per year. So $10,000 in this portfolio you'd get $99 a year. That's a 0.99% yield. This is the 5-year dividend growth rate. You can see that VU has grown at just under 5%. VGT is almost 9%, and QQQM is an impressive almost 11%. So this is the weighted average here of the CAGR. And then this is the 10-year total return for each holding and the weighted average 10-year. All right, we're rewinding the clock. I received $10,000 to invest in my teens. We'll say I'm 15, 16 years old. I would put 5,000 of it in the market, the S&P 500 or VU, and you could use VTI for the total US stock market. It's very similar to VU, or VT if you want a mix of VTI, total US, and VXUS, total international. So VT is the world stock market. VTI is the total US stock market. I prefer VU, VOO, is the ticker, which is the S&P 500. So I would stick half of it in the S&P 500, and then I would stick the other half in my favorite growth ETFs. So I like an even mix of VGT, which is all technology, and QQQM, which is the NASDAQ 100 index, 100 of the largest non-financial stocks in the NASDAQ. I like QQQM because it does have multiple sectors. It's not 100% tech, although it is about half tech. And I like VGT because I just am a tech bull and I believe it's the future. Don't really care what it's done in the past. It's been great in the past, as you can see here in the 10-year return, but I'm more concerned about what it's doing in the future. So yeah, I would take a 50-50 mix of growth and a cornerstone holding. And for these, you could also use SCHG, VUG, SMH. You throw together your favorite growths. This is how I would do it. So the 10,000 is invested. We have about a 1% yield, $100 a year of dividends. They grow at 7%. So this dividend yield on cost will double every 10 years. And the total 10-year return was 363%. Not too shabby. Investing in your 20s. The ideal portfolio mix will remain about the same when you hit your 20s. You still have plenty of time to ride out any crashes that the market throws your way. Remember, this is only the case because we're in passively managed, low-cost ETFs. Keep those young fingers away from picking too many individual stocks. Here we'll nibble on dividends just a bit to get the snowball rolling. Let's check it out. Here's that similar mix that we're going to use now that we're in our 20s. So VU, I kept it 50%. So I would put the same $5,000 of the 10K into VU, just like I did in our teens. I kept 40% in the growth mix. And for me, again, that's VGT and QQQM. And now I just want to get a little sliver of dividends growing. I like SCHD for my value/dividend ETF. And that's $1,000 just to get that higher yield and that better dividend growth rate. You can see it's 3.34% of a yield and its growth rate is 11.8% per year over the last 5 years. Now it sacrifices on total return, but you still have a nice juicy 333 with the weighted average. We're going to look at a summary tab that compares all the age results at the end. It's time to implement more value into our portfolio as soon as we hit our 30s. The portfolio will still lean towards growth because we still have over 20 years left in the workforce. On a side note, you've likely ramped up your earnings by the time you're into your 30s. And you've also likely gotten most of your stupid mistakes out of the way at this point. Now is when we stop caring what people think, stop lifestyling up, and ramp up that savings rate. Feed the machine. This is also the decade that you will begin regretting not making better decisions in your 20s. At least that's what I've heard from others. I've never made any stupid mistakes personally. Okay, whatever. Let's move on to the screen share for the 30s. All right, now we're going to throw in a little bit more value. And again, I use SCHD for this. You can use VTV. There's a lot of different value and or dividend tickers. This is basically 100% value and dividend. So I like SCHD as a complement to these, little to no overlap. Whereas like VIG and DGRO have more overlap with these. That's why I go with SCHD. But now we're ramping that up to 20%. And we're going to take down the cornerstone VU to 40% here. I left VGT and QQQM. I left growth at 40% because we're in our 30s here. We're still young. We have lots of years left to let this ride out. So I would put 4,000 in the cornerstone, 4,000 between these two in growth, and 2,000 in value at this point. And as you can see, our yield is increasing. We're up to $146 per year. Our dividend CAGR has gone up a little bit. It's at 8% because that SCHD throws in some nice CAGR. And we're still at a nice juicy 329% returns. Not too bad over the last 10 years. It's been one heck of a bull run. Investing in our 40s. Welcome to my decade. This is the one where we start figuring out life a little bit. Although I'm sure by the time I hit my 50s, I'll be looking back at a decade full of new mistakes, but what do you do? I think an equal mix of growth and value ETFs is the recipe for success in our 40s. Let's check it out. All right, out to what is clearly the best group, us in our 40s. So here I literally need to practice what I preach, otherwise it would get a little awkward. And I roll with 33% VU, 34, I guess, percent growth between these two, VGT and QQQM, and 33 ramping way up on SCHD. Again, that gets our yield a little higher, which produces $176 of dividends a year. Our dividend CAGR's up a little, so this thing's gonna grow over the years by simply doing nothing. And we're still over 300% on our 10-year total return. I like the balance between a cornerstone, growth, and value here. Investing in our 50s. This is the decade where we officially begin to lean more towards value. We want to get the cash flowing and the portfolio stabilized before the next big crash. The earlier decades had us licking our chops when the market would take a dive. We were swooping up more shares for every dollar that we invested. And that's still true in our 50s. We're far from being old, but a major crash will make us begin to do a double take. Let's look at how we protect our portfolio value without giving up all of our growth upside. All right, so we're ramping SCHD up to 50% now that we're in our 50s. And then growth, I took a slice off. Now we're only at 20% growth. and still 30% of the market. You can never go wrong by riding with VU, VTI, or VT. So you can see the number breakdown here. We're officially over 2% yield, $220 of passive income per year for every 10,000 we put in. Our dividend CAGR is at a juicy 9%, and our total return dips a little. SCHD will do that compared to these growths, especially in the last decade. We don't know what future decades are going to do, but we're still 264% return on your money. Not a lot of people complain about that. Investing in our 60s. Now it's time to increase that cash flow, assuming those bills aren't getting paid with the lower yielding portfolio. To reiterate, you can continue to invest like we did in our 40s with that equal mix indefinitely if you have the portfolio value to live comfortably on the traditional 4% rule or the dividend cash flow. But most of us will want to find a higher dividend yield now to preserve portfolio value and to take care of those pesky expenses. Let's hop over to our 60s. We're bringing in the big dog. We're going JEPQ for cash now. So JEPQ has a almost 9% dividend yield. So $2,500 in that gets you $220 alone. That's more than the full $10,000 in and of itself than the other age groups. And then you still sprinkle in a lot of SCHD. We crank that up to 55%. The growth now can be at about 10%. I still think you want some, because you still want these long-term zoom out returns through all the crashes. They'll go way down, but they'll go way up. And then the market I put at 10. So we have 10% cornerstone, 10% growth, and 80% dividend. And within that dividend, we're still mostly this grower for SCHD if we can afford it. Here's where you'll need to ask yourself, if 4.24% yield isn't enough, put more into JEPQ. If you already have enough from other sources, a pension, Social Security, or just a big portfolio value, I'd get rid of JEPQ altogether in that position and throw more into SCHD, or even into a balanced mix if you really have the portfolio value. Investing in our 70s. Our portfolio mixes will vary drastically from one another depending on the value that we built up to this point. If you have over $10 million at this point, you could roll entirely with VU, Boglehead 3 fund, or the 40s mix to produce enough cash flow to pay your bills. We're going to assume that the portfolio hasn't blossomed like that for most of us. Let's create some more juicy cash flow. All right, for our 70s, we're cranking up that JEPQ. We toned down SCHD a little, but we're still really high. It's 90% between dividend ETFs, and then just 10% riding in the market. You can never go wrong with that. If you need every last dollar from your yield and 5.6% is not enough, get rid of VU, get rid of or reduce SCHD and crank more into JEPQ. And of course, if you have a huge portfolio value, get rid of JEPQ and do all the opposite logic. Focus on this growth, this 5-year dividend CAGR, and total return over time if you're already cash flowing all right and you don't need that 5.6%. Okay, I think this is a good summary to see the differences in our age-based investing. And I want to throw out, it has been a bull market. Okay, all of these are juicy. We don't know what the next 10 years will be like. All we can do is look back, but I just want to be clear, this is past performance, of course. As you can see, when we're younger in our teens, and as we progress through our 20s, 30s, 40s, and so on, our portfolio mix steadily increases our dividend yield as we slowly need cash potentially, or we want to get the snowball rolling to work towards retirement. And the dividend CAGR has more of an emphasis as well. These are weighted averages here, so they go up. And then when you start throwing JEPQ in, they go down. So you can see it's the highest in our 50s. If you can afford to just roll with SCHD and not need this higher yield, then this could have kept incrementally going up with proportionally more SCHD. And then our 10-year returns. See, this is where your return was pretty hot in your teens, right? And it slowly gets reduced a little bit each year, but that is what you give up. You have to have safe dividend yield and cash flow coming in. You really have to give up something, and usually it's total return. But again, if the market crashed, say another .com, all of a sudden this total return will be higher and the yield will be higher. So this is an extremely lucrative market in the last 10 years, and we won't always see figures like this, no doubt about it. But even with that said, I recommend in your younger years pounding money into that growth, and if the market crashes, throw in even more money. You have lots of time to see it bounce back. We can argue about the small nuances of a portfolio until we're blue in the face. The bottom line is that you need to invest as much as you can afford as soon as possible, period. To stay motivated, remember this rule. every dollar you put into your portfolio will double every 7 years based on the historical market averages. Think about that impact the next time you throw an extra $100 into your portfolio. I'm sure you want more of this stuff, and YouTube recommends that you watch this video right here. The AI is a lot smarter than I am, so I'll just say, go watch that video right there. Thank you for watching, and I will see you here next Sunday. Peace.